with the Deutschmark. We became heavily involved in the DAX and the FTSE, and obviously the S&P going forward, the Dow Jones going forward. And this is an incredibly valuable subject for the banks. We make an awful lot of money with this because it's where we can reduce risk but still have massive upside profits once that idea is formed. And now Cliff was asking the question about index arbitrage, not specifically cross-border index arbitrage, but looking at the index arbitrage model of just the US markets predominantly. And one of the things we were talking about, of course, was the class we did a few weeks ago when we started to look at the growth value relationship in line with the concept of discounted cash flows. And a lot of people think that the indexes should basically go along a stochastic type process, and they should be able to see something very, very akin to what I'm just about to draw for you. And that's obviously not the case, and that's why a lot of people end up getting a little bit screwed up with index arbitrage, because index arbitrage should technically look like this. You should be able to trade index arbitrage, one would imagine, and feel that this is what index arbitrage should look like, right? It should, if you can get it right, if you can reduce a trade to a chart that looks like this, you've got a world of massive gains. It's like the person that's that wants to trade the Prem. You can't lose. You just have to have massive size to make any money at all on the Prem. You have to have massive technological advantages to make any money on the Prem. But this is what the Prem chart looks like, of course. You can't lose if you can secure that high price and low price on the Prem. You can't physically lose. It's impossible to lose. It's called pure arbitrage in that sense. And it is a pure arbitrage. Well, index arbitrage isn't pure. It's called statistical arbitrage. In other words, it's a basic probability. So it would be fantastic if we could sell the highs and buy the lows in an argument that looks like this. But unfortunately, for index arbitrage, it doesn't look like this. It looks like any other chart. And that's where the problem is. An index arbitrage chart can look like this. It can just simply look like a trending move. Now, the reason why it trends, of course, is a thing called discounted cash flow. One of the big reasons why it trends is because of that concept of discounted cash flow. So if you can normalize the highs and the lows, if you can put it into a situation where those highs and lows basically go along this type of structure, which is possible through the use of something like the Z-score, for example. But the Z-score would not be based on the actual underlying price. The Z-score instead would be based upon the relationship of the discounted cash flow and the index arbitrage. Then you start getting into something that's more akin to what we do in the bank desks when we're doing index arbitrage. So this baseline here is not a baseline that's formed by the price. This baseline is formed by discounted cash flows. Discounted cash flows. And therefore, inside that baseline, of course, one of the things that we would then see is that there is the equivalent of that there. This line that's moving, this line here, that's moving to the upside, of course, this is the discounted cash flow line. That line is this line. So basically, we're just rotating this chart on its side, and we're trying to trade these types of stories here. And obviously, that means that there's a very, very delayed reaction on selling these stories here based on the discounted flat cash flow concept. So very, very interesting, I hear you say. Yeah, but it's impossible in the basic framework to do that on your trading view chart. So you would have to do a little bit of programming to find that discounted cash flow line to work your price action against. So when we're looking at it from just a manual observation point of view, this is the growth value relationship that we were talking to Cliff about. And obviously this growth value relationship, you see quite clearly, doesn't look like a stochastic. It looks more like this trending move through this phase, which is exactly right. But if I overlay the discounted cash flow function, one of the things you'll be able to recognize is that this is actually very much like a stochastic type. And when I look at the discounted cash flow, this is what it looks like. You can see where the discounted cash flow comes from. So in other words, during this period here, if that's the discounted cash flow line, then obviously the stochastic that runs through the price during that period would have highlighted this as a bottom edge and this as a bottom edge, might never have highlighted this as a top edge. So you'd have been able to buy this here and you'd have been able to buy this here. Now, during this whole process here, you can see as you get bigger and bigger narratives, the discounted cash flow looks more akin to this, doesn't it? It's almost perfect. So you can see inside of that discounted cash flow, you can see the opportunity to buy here, potentially sell up here, and most definitely buy back in here. And you can see that this is almost definitely going to become a sell opportunity up here. Now, one of the things I said to Cliff was, well, this is interesting because this discounted cash flow can also become a trade, can't it? This discounted cash flow can also become a trade narrative because you can hedge your index arbitrage against the discounted cash flow. Unbelievable, isn't it? So in other words, you can see at the very top edge, if I see the discounted cash flow, if I can see this narrative evolving here where we start seeing some weakness, so we're starting to see some growth weakness, which suggests that the idea of interest rates, for example, is going higher, that would mean that I could quite easily put a sell into the top edges up here and make money, right? And that's exactly what happened. We sold the bonds, and we sold the bonds into those overstretched functions at the top edge. Into the bottom edge, you can see I could have bought quite aggressively to hedge out of that discounted cash flow function, couldn't I? You see what I'm seeing, Cliff? You see what I'm seeing? I could have hedged into that as a buyer right there on the candles against those two short positions here. Now, obviously, when that opens and we get this surge, well, that's obviously going to close out this orange condition. You're going to close out that orange trade right there, which is what I was talking about when I was talking to Reeve about one of the big reasons why you should have closed off your bond, for example, was because you saw that condition changing quite dramatically. And therefore, obviously, in line with that, you'd expect the bond price to be driving higher up and through top edges. You'd expect the bond to be driving higher and up through top edges. And that's exactly what is happening just now on the bond price. And that little piece of information allowed you to get off your bond at the perfect price and make that money, Reeve. So that conversation I was having with Cliff is the same conversation that I was just having there with that bond trade as well. So we should be able to be aware of that discounted cash flow function that is involved in the growth value relationship and try and take advantage of it as it evolves on the right-hand edge. And sure enough, that's helped anybody to get away from that short bond trade at the top edges. And you can see what's happened to the bund, for example, the sell that came in the bunds at the top edge. You can see when that trade started to come in, you can start to recognize that the price then pushed through that top edge, and it became quite easy to be possibly even bidding for that swing to go back through the top on bunds rather than trying to sell into the highs, which is obviously just an absolute bust. No way forward for that trade. No way forward.